Welcome to this video, reviewing the tape from Monday, June 22, 2026. This is Operation Reentry, where we explore the market's recent movements and current outlook. Please note that this video is for educational purposes and is not financial advice. We are sharing our process for reading the tape, trade your own plan, and manage your own risk. It looked like a quiet day, but it was anything but. Indices stalled at core resistance, while money rotated into leadership. SpaceX's listing was a major headline, and there is significant risk building on the horizon. SpaceX experienced a complete round trip, opening at 150, running to 225, and closing back at its IPO bid. Many buyers are now underwater, making this a critical chart to watch. In this video, we will cover 6 key fronts: market structure, leadership and rotation, the SpaceX reentry, the semiconductor outlook, macro risks, and our game plan for the road ahead. Section 1 covers market structure. We are looking at core index resistance, a stubborn downward trend line, and upcoming rebalance risks. The S&P 500 reached a core institutional level and rejected. The NASDAQ followed a similar pattern, popping early before fading. Understanding these levels before they happen is key. The downward trend line remains the boss for the NASDAQ. Were rejected immediately after crossing it this morning. The index must deal with this level before any significant upward movement occurs. Looking at the hourly RSI, we see a pattern of lower highs. Each peak is lower than the last, indicating a rejection at the trend line rather than a reversal. On a 4-hour chart, the NASDAQ is struggling to close above the June 4th gap-down line. We have repeatedly tested the high of the June 3rd bar and have been rejected each time. As noted on the tape, we keep retesting these levels and keep being found wanting. The market has completely rejected these attempts to move higher. These are the current battle lines for the NDX. Unless we see a daily close above the June 4th line, the index remains range-bound under resistance. A massive $165 billion rebalance is queued for this week. These mechanical flows can drive market movement regardless of fundamentals, so we are keeping a close watch on the dates. In summary, the market is heavy at the top, but not falling apart. We are pinned under resistance, but the rotational strength is a factor to consider. Moving to Section 2, we'll dive into leadership and rotation, where money continues to flow into the strongest names on the board. While the overall index is stalling, we are seeing some interesting divergence. Semiconductors and industrials both closed at all-time highs today. This kind of leadership in a stagnant market suggests that capital is rotating rather than exiting. The semiconductor sector, or the SOX, hit a fresh all-time high. Despite facing the same resistance levels that capped the broader index earlier this month, the semis pushed through with strength, signaling clear market leadership. The SOX structure flipped previous resistance into a launchpad. By reclaiming the June 3rd and 4th levels rather than rejecting them, this sector confirmed its leadership. When the leaders are at new highs, it is difficult to argue that the entire market is about to break. Looking at the SOX RSI, we aren't even in overbought territory yet. This suggests there is still room for momentum to continue as we head toward the Micron news on Wednesday. It wasn't just semis. Industrials also reached an all-time closing high. Caterpillar is a key example here, gapping up and maintaining those gains. Seeing 2 major sectors hitting record highs at the same time is a strong sign of real rotation. The industrial sector gapped up and never looked back, refusing to fill the gap. This strength, particularly in names like Caterpillar, shows capital actively flowing into these segments, which is inconsistent with a market on the verge of a collapse. In the industrial sector, we are watching Caterpillar, GE, and GEV. Caterpillar is clearly breaking out, GE is holding key support levels, and GEV is showing resilience, with few historical closes higher than today's. We are also tracking rotation in other areas. Steris is showing a textbook retest after its earnings gap, while financials are currently digesting their recent gains after the Fed speech, remaining stable but not leading. So where is the damage? It is sector-specific, primarily hitting areas like crude and aerospace rockets, not the whole market. Industrials and semiconductors are soaking up capital, which keeps the broad market thesis from being purely bearish. Our money flow scoreboard confirms this. Semis, memory, and industrials are at the top of the leaderboard for relative strength, while crude and rocket-related names are lagging at the bottom. The takeaway from Section 2 is simple. The leaders are voting bullish. With semis and industrials hitting new highs and money rotating into specific winners, the market is showing resilience despite the pressure on the broader indices. Now let's move to Section 3, the SpaceX reentry. This event has had a ripple effect, particularly hitting the rocket sector as this trillion-dollar entity returned to its IPO level. The space complex entered the market with extremely high revenue premiums. Remarkably, some peers were trading at even higher premiums than SpaceX. This overextension made the entire group vulnerable to a re-rating when the main catalyst struggled. The problem was that space ETFs weren't positioned correctly. They lacked the capital or hedging strategy to accommodate a name like SpaceX at its IPO price, leading to a significant valuation mismatch across the sector. Ultimately, passive funds like UFO and JEDI were caught unprepared, and the resulting sell-off was a direct consequence of that lack of planning. This serves as a clear warning about the risks within niche, passively managed sectors. Looking at the broader rocket basket, we see widespread weakness. Rocket Lab, in particular, was trading at an unusually high premium, and now it's feeling the gravity as the anchor, SpaceX, struggles. SpaceX's hourly chart shows a textbook round trip. It opened at 150, climbed to 225, and failed to hold, ultimately closing back at the 150 mark. The move to 170 proved to be the critical turning point. 4 numbers define this session: the 150 IPO open, the 225 session high, the 170 trigger strike, and the 150 close. Only those who bought in the first 5 minutes are still green. Everyone else is underwater. The options activity suggests heavy institutional hedging. A large call seller capped the upside at 205, while aggressive put buying at the 170 strike created a clear floor that eventually gave way. The 170 level was the primary trigger for this sell-off. Multiple attempts to reclaim 170 failed, and once that support level broke, the path back to the IPO open was essentially sealed. As noted on the tape, the market is sending a clear message. There is no upside momentum until the price action stabilizes and shakes out the remaining weak hands. In terms of auction structure, price is parked at the low end of the value area. This is a critical zone. If it loses the value area low, there is little structural support left to hold the price up. The VWAP anchored from the IPO print has been broken, a major sign of weakness. Going long here means betting against everyone who bought at the listing and is now sitting in the red. The math is simple. The only profitable participants are those who entered in the first 5 minutes. The remaining float is offside, confirming that the current structure is heavily tilted toward the downside. We are now seeing a collision between the IPO-anchored VWAP and the peak-anchored VWAP. This level is crucial for the path forward. Until the price reclaims the IPO-anchored VWAP, we remain cautious. For a short-term flip to the upside, 163 is the number to watch. Reclaiming this VWAP level would provide the first sign of defensive strength. Without it, the trend remains clearly bearish. Our trade setup involved managing a short via 170 puts. While it began as a spread, we rolled the position lower into the close, positioning ourselves for further potential downside weakness. Structural pressure remains high, as roughly 60% of the float has yet to come due. This impending supply overhang is a key reason why the stock stays heavy and struggles to find a bottom. Looking ahead, 150 is the critical line. If we break below that, 135 is the next major level that could trigger a move from an orderly decline into a disorderly sell-off. In summary, SpaceX has completed a full round trip, and the structural risks remain significant. Until it shows signs of stabilization, we are keeping our distance. If you're looking to trade the sector, SpaceX remains the cleanest short. This video covers the 4th section, focusing on semiconductors and specifically Micron. We look at how the leading sector is reacting to an upcoming catalyst, and how institutional buying is absorbing retail selling. SOXL has been exhibiting a consistent pattern. Price drops to core levels during the day, then rallies by the close. Institutions are buying the dip while retail sells early, creating a predictable daily cycle. As noted, retail sells while institutions buy, a pattern that has become remarkably consistent. This behavior continues to be a positive signal for the current market action. SanDisk held its opening level up to 350, then became a net seller above that point. While the closing action wasn't perfect, the daily chart remains coiled with potential for a gap fill before the Micron announcement. Micron is now the primary focal point. The 1,200 call wall was cleared right into the market close, which is a significant development to watch. For our positioning into Micron earnings, we have maintained a long stance. We cleared the call wall late, added exposure, and sold our 1,200 puts into the close to capitalize on the level holding. Micron has seen a significant move, rallying over 100% since its March lows. This setup creates the potential for a quote-quote sell the news event following the upcoming earnings release. Remember that a great quarter does not always guarantee a great market reaction. Given the massive move leading into the report, it is crucial to size positions appropriately for this binary catalyst. Here is the playbook for a post-earnings fade. A simple earnings beat is not enough. We must watch how the stock actually trades. Keeping the 1,200 level in focus is critical, and we are also monitoring SanDisk for clues. The memory complex remains strong, with DRAM printing at 8,150 after hours. With other key names also breaking out, the momentum in this sector is still clearly visible. We see confirmation across the sector. DWI is back to its highs, SanDisk is part of the breakout, and the recurring pattern of flushing and then chasing shows strong institutional accumulation. Mapping the levels for Micron, 1,200 is our key call wall, DRAM at 8,150 confirms demand, 310 is our base, and 463 represents supply overhead. Our main takeaway is to maintain a long bias while respecting the binary nature of the event. Watch the institutional patterns and be prepared for potential volatility. Moving to the next section, we look at our macro risk radar. We are monitoring several factors that could impact market stability, including the upcoming print, global meetings, crude oil, and PCE data. Risk number 1 is the Micron announcement. Because of the massive run-up, the market reaction is vital. Always know your levels before the news drops. Moving on to risk number 2, we address the Japan-US carry trade. It is back on the radar, as cheap yen borrowing has fueled recent equity purchases. We experienced an unwind in August 2024 that hit equities hard. While some think we will not get fooled twice, complacency about this known risk is exactly what could cause trouble. Recent developments include the Japanese finance minister being out for a medical procedure and an emergency government meeting regarding the yen occurring today. The transition from watching the yen creep to holding emergency meetings suggests the risk is becoming more real and immediate. Here's how an unwind impacts U.S. stocks. Investors borrow cheap yen, buy equities, then must dump those assets fast to cover margin calls if the trade unwinds, creating forced selling pressure. Risk number 3 concerns the crude oil trade. The connection between crude and the USO is currently broken, suggesting it is time to step back from that position. While the gush trade remains challenged, remember that a dead trade in one sector often signals an opportunity in an adjacent one. Tankers may be waking up. As diplomatic channels and funding talks potentially reopen, the tanker sector, including Frontline, is starting to look interesting again. If shipping lanes continue to stabilize, the tanker complex is definitely a sector worth monitoring closely for rotation. Risk number 4 is the upcoming PCE print and what the bond market is telling us. While PCE is backwards looking, the current yield environment requires attention. With the 10-year yield at 4.51% in the dollar firm, the market may be signaling that the tape is heavier than the major indices indicate. I am not losing sleep over a broad market collapse, as the leaders remain at record highs. The current weakness is localized and specific, not systemic. Under the surface, the 10-year yield, the dollar, and the overall tape feel are providing quiet warnings that we are watching closely. We are keeping a close eye on the 135 level for SpaceX. If it breaks, it could trigger significant forced selling due to the sheer size of the holdings involved. To summarize, watch the Micron catalyst, monitor the yen for carry trade volatility, look for rotation into tankers, and stay alert to the signals from the bond market. Let's review the cascade chain scenario. This outlines how a drop in SpaceX can become a broader market issue. It starts with the breakdown of the stock, forcing holders of a $1 trillion listing into liquidation. When these holders need to raise cash to support other positions, they sell their SpaceX holdings. This forced selling doesn't stay contained. It spills over into adjacent risk assets, turning a single-name breakdown into a market-wide problem. This is a low probability but high-impact tail risk. We are mapping this scenario rather than predicting it, as preparation is key to navigating such volatility if it arises. Turning to our Trigger B scenario, Japan pulls the thread. If the carry trade unwinds, the forced selling mechanism we just discussed kicks in directly against U.S. equities. This time feels different, due to the combination of emergency meetings, an ill finance minister, and a familiar 2024 pattern. The setup is certainly there. For this scenario, keep the yen and Japanese rates on your screen. A sharp move in the yen serves as the early warning system for everything else in the market. Our third trigger concerns Micron. Having run up over 100% into the print, this is a binary event. A miss, or even a soft beat, could reverse the leadership currently holding up the tape. Even with a beat, watch for a quote sell the news reaction. After such a massive move, fantastic results might not be enough to sustain the rally. We are watching the 1,200 level as our pivot. If this level holds post-earnings, the current leadership thesis survives. This slide maps our odds on key breaks. Remember, none of these are formal forecasts. They represent the scenarios where HPT is currently sized and prepared to act. Our long playbook emphasizes buying leaders during institutional flushes. Look for the morning puke into a close-of-day bid in sectors like semiconductors and industrials. Respect the all-time high closes. When leaders like industrials hit records without being overextended, they still have room to run. Don't fight them. Regarding our defense playbook, avoid SpaceX longs until it reclaims the 163 level. We are also stepping aside from crude, as the breakdown in USO suggests moving focus elsewhere. We have summarized the key levels for tomorrow's session. These represent the essential points we are monitoring across our entire board. To wrap up, remember that SpaceX is our primary tell. While the leaders suggest the bull is alive, we must respect the potential for downside. Trade the leaders, watch the re-entry, and stay disciplined.